Hello and welcome to Trading Blows from TraderX. Another busy show ahead and plenty for us to discuss with the panelists this week, including the US inflation figures that we had out on Tuesday and the incredibly choppy and violent market reaction that we saw in the aftermath of that. What we think UK assets are likely to do over the near term as growth slows, the labour market remains hot and inflation continues to recede from the highs. How close the BOE are likely to be to the end of the tightening cycle, and where the balance of risk lies for equities and for G10 FX going forwards. Without further ado, let's get into things. So, a big show ahead. Without further ado, let's meet our panelists. They're going to go head to head. As always, over 4 rounds, they will score points for a great response and for actionable trade ideas, and they will have the threat of points being chalked off if a dispute is raised over their answer. The better the response, the more points they will score. Joining us today, Ryan Paisey, the founder of PIQ Suite, a market intelligence and news platform. This is the smartest I think he's been dressed on one of these shows. David Belle, the founder of Macrodesiac, a macro analysis service, and the best dressed man on the show, Richard Matthews, the founder of Pardus FX.
Do I get a bonus point if I disagree with that and say you are the best dressed person?
You don't, but you might get a point talked off if you chat over my intro again. A specialist provider of FX for corporate, institutional and high net worth private clients. Before Ryan interrupts me again, let's get into the first round. Well, he's obviously eager to talk, so I'm going to go to him first in a second. Should we be worried about inflation? The US CPI number that we got in on Tuesday was interesting, to say the least. The market reaction perhaps a little bit perplexing. Just to run through the data, headline CPI coming in at 6.4% year on year. The core number printing 5.6% year on year, both a little bit hotter than we expected. But when you drill into the data, the monthly increase, which was 0.5% on the headline figure, about 50% of that came from shelter and from housing costs. So what do we think of the inflation data? What do we make of it? What do we think it does in terms of the outlook for the Fed? I think the market now prices in a roughly even chance of the Fed hiking rates all the way through until June. Is that right?
So I'm guessing we're talking to me now.
Yeah, we are.
Yeah,
cool. You have the floor at last.
Thank you. Hello, everybody. As you know, the Right Honourable Mike said, something for everyone. Yesterday in the inflation report. Reacceleration from the previous prints on the month-on-month, flat continuing to slow on the year-on-year. Something to note, maybe something for the hawks out there, is the 0.5% increase on the month-on-month, on the headline month-on-month, was the biggest increase since October, which is that's a little factoid that I think has gone under the radar slightly. The housing component, as Michael rightly said, was the biggest contributor, 2.5 points of the 6.41%. Everyone's suggesting, it's only shelter, it's only housing. Should we ignore that? I used to believe that. I used to think the same. However, when you look back at the data, that component has been increasing. Pretty sure, if my data is correct, and it's me, so it's quite possibly that it's not correct. It looks to me as if it's been increasing every month since April 2021. Which, when you think of it that way, it's not been going away. So, at some point you think, it's done enough, it is due to turn, but at the same time, it's been around for a while and it's continuing to grow. Something to note, which again, no one else seems to be talking about, unless you follow me on Twitter, in which case I tweeted it about 10 times yesterday, was January data had a new methodology to the weightings. This weightings was, they took, rather than take a 2-year backstory on consumer expectation survey, expenditure survey, not expectation survey. Rather than do 2 years, they just did 1 year. That had a inflationary bias because it put more onus on shelter, which again, this is also the main component, and it took away some now deflationary weightings such as used car prices. So was it a surprise we saw a small bump on the January data? Probably not. I think Goldman Sachs were kind of very late in doing their CPI preview, and they took this into account. And as you would have it. It was bang on the money almost. So yeah, I'm not too put out by the hawkish side of the CPI data. In terms of what it does for the FOMC, I think at the moment we're pricing in roughly like 25 hike March, May, cuts later on in the year. I'm completely on board with that, to be honest. I was thinking maybe we even see a cut in July. Maybe that was a bit too ambitious. I'm now thinking September. I have got a very controversial kind of little thought here, if you want me to go with it now, or do you want me to come back with it later?
Hold that controversial thought, because I want to go to Dick, because you said cuts in September. Dick, I know you've been very vocal on the market not believing higher for longer. Do you think cuts in September are anywhere near a realistic possibility?
No. In a word.
I was hoping you might say a bit more than that.
Yeah, I don't think they're going to cut until early next year. I think the terminal rate is going to be higher than people anticipate. I think we're going to see Fed funds up at 6%. And they are going to sit there and they're going to throttle inflation until it's dead. And I just don't see them cutting. There's no need to. The economy is still bouncing along. Non-farm payrolls still look good. I just don't see them cutting until next year. And as Ryan was saying, shelter's an interesting thing. You've got to pay for it. There's still inflation. You can't just do away with it. I wouldn't mind doing away with it on a month-by-month basis.
It's probably the most inelastic. It's probably the most inelastic component in there as well. Like, everyone has to pay for shelter.
If I'm not paying for shelter, I'm paying for a bar bill, and either way, it's going up.
Well, exactly.
No, you're absolutely right. So, Dick, if the Fed funds rate gets to 6%, where's the S&P trading? We're at 4,100 now. I know we're going to get onto equities in a second, but just briefly.
I know, and I'm going to have to. It's a bit like saying buy the euro. I still think, unfortunately, you've got to buy the S&P. I think it rallies up. It's stuck in a range really at the moment, isn't it? But you can see it continuing on probably for another 6 months till you get the next set of earnings. Although it only yields 1.6%, which is ridiculous compared to what you can get for bonds. So unfortunately, I got to say buy the S&P. I don't believe it, but I think it will go higher.
Well, we'll get onto that a little bit more in the second round. David, I want to bring you in. We've got Uber Dove Ryan saying they're going to cut in 3, 4, 5 months' time. Dick saying we're going to get to 6%. Where are you between those two extremes?
Well, firstly, I don't think that's really what Ryan's saying. I think he's just saying that's kind of what the market's pricing.
Yeah, David is correct. That I'm not ruling it out, but we'll wait until my controversial point.
Yeah,
backpedaling there, I think, from Ryan.
Well, a little bit.
Yeah, I think there is as well.
But to add on to that point, and I think I made this point last week as well. If we're trying to gauge, where an accurate terminal rate is, we can't. I don't think we really can at the moment, because if we look at the repricing of the June meeting, in terms of where we shifted another 25 basis points higher. And for some reason, no one's really talking about that as much as they probably should be. And that's really my primary focus is, how sort of volatile are the market expectations on a forward-looking basis for where interest rates will be? Because if interest rates are going higher, if you're looking at it from a trading perspective, what's the probable sort of outcome? It's probable that risk would either remain flat or sell off. And then from there, you've got to think of what you'll do. Now, from my perspective, it's probably preferential to play that via FX than equities, because equities are an absolute minefield. So the likes of, with the RBA being a little bit softer versus the Fed and this repricing higher of interest rates, you probably want to sell the Aussie versus the dollar, or sell something like CAD versus the dollar. CAD's maybe a little bit trickier because of the oil component, but I still think that's the right play. Commodity currencies versus the dollar, based off of this sort of repricing higher. And I tend to agree with Dick as well, that the terminal rate will be closer to 6% than it will be to 5%. I just think that there's the risk, and the Fed are probably very much thinking about this, that there is sort of another resurgence of inflation. And that's very interesting what Ryan said about the shelter component. I didn't know that. That's the what, like two years now that it's been going up nearly?
Mate, it's what I'm here for.
So that is a very interesting point. But yeah, with all the geopolitical tensions and things like that as well, anything can spark off. This Turkey-Syria stuff, Arab Spring 10 years ago, these volatile states and places like that is where stuff can spark off.
People have been saying the Middle East is going to spark off for like literally every day since 2000 BC. To be fair, so I think you clutch onto those pearls, you're going to go poor.
No, of course, but that's why in terms of sort of, I guess, qualifying out trades, you can think, okay, what could actually just blow my trade out of the water?
UFOs, that could blow your trade out of the water.
Some things are in a hot air balloon.
UFOs.
Just check out the window. There's none hovering overhead at the moment.
We did have an alien abduction incident recording the trade-off earlier this week, so let's not mention UFOs. David, I like your point on commodity currencies. That's a play that I've mentioned a couple of times recently. Just in the interests of time, we best let Ryan have the floor and hear his controversial point. I know he's been bottling it up.
So it's maybe it's not just maybe for this segment, maybe it just rolls over to a general way of thinking. Okay, right. So we've been kind of brainwashed. Well, I said recent times has made a lot of traders, especially new traders, brainwashed into a ZIRP world, zero interest rate policy world. However, that's not what central banks are about, right? Central banks, this may be a controversial view to many, but central banks would like interest rates to be almost as high as they can get away with, right? Because that makes sense. Like Dickie's been around for a lot longer than most of us, no offense, but you would agree that, the higher the interest rate that central banks can get away with while still stimulating the economy is the ideal situation. Okay. So maybe we get up to the terminal rate, I don't know, let's just say between 5 and 6, let's just, 5.5%. Maybe we stay there for a while. And the economy, the US economy or the US stock market, more so than the economy, continues to grow. Maybe the economy starts rebounding, continues to grow. Why would the Fed cut rates if that's happening? Do you see what I mean? It's so easy for us to fall into the mindset of, as soon as everything's right, we cut rates again. Well, that's not what happens. Central banks cut rates when there's issues, when there's problems. So if we get up to 5.5% terminal or 6% terminal and things are back on track, there is absolutely zero need for central banks to cut rates, or the Fed in particular to cut rates. I think that's something that, I've been around for 20 years. Dickie's been around for 60 years. And even we forget that sometimes. So for newer traders, it would be almost impossible to get your head around the fact that central banks only cut rates if they need to stimulate the economy. And at the moment, perhaps we don't need to do that. So that's one thing. I have got another thing that I just want to briefly touch upon, and that's only because it's happened in the last couple of days or yesterday. Brainard, obviously FOMC member, being appointed to Biden's head of the National Economic Council. That does give a slight hawkish skew to the FOMC. If anything, just because she was seen as the coalescing force of the doves on the committee. So they're kind of their spokesperson, kind of all to rally around. She's no longer there, which again is another kind of little iron in the fire for maybe at least the terminal rate remains higher for longer. I'm not saying they hike higher, but it's another factor to bear in mind when you're thinking, are they going to cut straight away? There you go. There's my little points.
And sorry, just to add on as well. The Fed probably want to get as far away from the zero lower bound as possible.
Hike when you can, cut when you must.
Exactly. So they the zero lower bound is a very unproductive place to be at. For any central bank, whether it comes to malinvestment, in the real economy, whatever. You can just see how asset prices go mental when interest rates are rock bottom. And the Fed don't want that either. They understand those dislocations. Yeah. Their hand is just, I guess, forced. And, they would love it to be at 10%. Absolutely.
Yes, certainly.
Well, certainly for the first 20 years of my career, interest rates were never always 4, 5, 6, 7, 8%. And it's only since the financial crisis when they brought them down to zero. They even took that nonsense of negative interest rates, which is lunacy. I disagree slightly, though, that central banks want to see higher rates, and that is when you confuse a central bank with the government because the cost of borrowing goes up so rapidly. I suppose if you've got inflation and high interest rates, then everyone's happy. The inflation is destroying what the government owes. But I think that they'll be happy to see rates back up at these levels for some time to come, which isn't good news for mortgage owners and house owners.
No, not at all. Well, on that note, great discussion. Let's get on to the next round. Good stuff. Well, we touched on this a little bit earlier on in terms of risk assets. So I'm going to go to you first, Dick, as you were the one to bring it up, I think. Equities have got stuck in a little bit of a range, haven't they? The S&P kind of between 4,100 and 4,200. We've had quite a lot of events that the market has moved through. We obviously had the blowout payrolls number at the start of the month, which saw us take a leg lower. We've come through earnings season, which hasn't been particularly bad. It hasn't been great either, a little bit uninspiring. I guess things could have been a lot worse when you read through some of the corporate reports and look at the transcripts that have come out of the earnings calls. The next Fed meeting's not until the 22nd of March, so that's still over a month away. What do you think we need to be keeping an eye on, Dick, between now and then? And I'm going to ask you to pin your colours to the mast a little bit. Which way do you think the next 100 points are going to be? And I'm going to ask everyone that question as well.
You've already asked me that, and I've already said I think it's upwards. I think it is. I don't believe it should be. It's two very different things. I just think it's unbelievable when you look at what's going on, the discussion we've just had about where Fed funds are going to end up, that people still can buy equities. I just think that buying risk assets is so dangerous at the moment. With interest rates still going to rise before the next FOMC, we've got another non-farm payroll to come out, which I suspect is going to be good again. I just don't see how you buy it. And to borrow David's favourite phrase, Goldilocks has got very broad shoulders at the moment, because whatever comes out, the market wants to buy. It's almost like whatever the number is, we're going to buy. We don't care. We'll just buy the dip. The market's going to rally.
Path of least resistance.
To me, it's a nonsense, but don't fight the market. And I guess I'd have to say the next 100 points are up.
Yeah, I think there's a lot to be said in that kind of don't fight the market that you mentioned. Ryan, I heard you say path of least resistance. Let's expand on that idea a little bit. I know that's what kind of drove us for much of, 2022 downwards, 2021 higher. Are we seeing the same idea in play again? Yeah.
As Dickie rightly said, it seems any excuse we buy it. And, and again, the default for equities is, because of even if you look back and really simplify it, just the flow of money, more money being produced, still being produced. I don't care how you look at it, but more money is coming into the stock market, every month. The path of least resistance will always be higher unless there is a real issue. In terms of your question, the next 100 points, to be honest, it's like if the next 100 points in the S&P, you're asking me where it's going to close today. If in theory it could close 100 points up or down today. So that's a coin flip. Where will it close the next 500 points? Higher, definitely. I've got no qualms about saying that. The bear market is dead. Bear market rally is clutching at pearls. In terms of a bear market, I hate the definition of bear and bull market of 20%. It falls to it. It's rubbish. It's a dated definition because volatility now has increased. It's like, the definition of recession, that's a dated, people are arguing about, what is the definition of recession? So there is no one fit all kind of definition for these things. My personal preference, if people are looking for a determination factor on what is it, bull or bear market, 200-day moving average. If we're above that, we're in a bull market. If we're below that, we're in a bear market. S&P is above the 200-day moving average. We're in a bull market. I think we're the top to bottom in 2023 is like 10% in the S&P. We're currently 8% off the lows. NASDAQ is phenomenal. I think we've had a top to bottom in 2023 already of 20%. We're 16% off the lows. People say we've stalled. I disagree with that. I think we're just taking a breather. I see no real downside. I see no, real kind of hurdles to overcome for the stock market to be retesting new highs in the next, 3 to 6 months, maybe sooner.
So we've got a bit of a bullish consensus forming on the panel. I must admit, I am starting to get into that camp, particularly after the CPI number yesterday didn't really derail things too much. David, where do you sit? Are you on board with Ryan and Dick's idea, or do you think we're in for a little bit of downside?
What are you doing, Ryan?
I'm cheering you on.
I feel like a rabbit. again, I think I mentioned already, I don't really like making a bet on equities at the moment. My view would be better placed via FX, which is compared to how FX and equities have behaved over the last couple of years, it's probably a big flip, you know. But it just seems to be a much more obvious trade. Like, I don't have a read on the S&P or ES or anything. You know, I buy VOO each month still, but that's just to invest in. I do not have an accurate read on where equities would go. And
well, hang on, you say that as if you've got an accurate read on where anything could go.
What I mean is I have a more okay. Let's change the word from accurate to more conviction. Then, if you were to ask me where I think Aussie dollar's going to go, I'd be able to say, yeah, I think, you know, spot 6.6 over the next 2 months. If you were to ask me where the ES were to go in the next 2 months, I couldn't give you an answer, because it as Dick says, it just doesn't necessarily make sense with the Fed funds where it is. So 100 points up or down, you know, as Ryan says, unfortunately, I've got to agree. It's just kind of like a nonsensical question.
That's a bit harsh, isn't it?
Take a point off.
Actually, I'll come back. I think the next 100 points is probably 50 up and 50 down.
Yeah, that's probably more like it, particularly given the volume we saw yesterday. David, I'm going to ask you about the Aussie dollar in about 10 minutes' time, but before we do that, we need to have a look at the UK, because there's quite a lot going on here, so let's get into the second half of the show. So things are getting moderately interesting when it comes to the UK and UK assets at the moment. Ryan seems a little bit dubious on that. We'll get into that in a second. Cable had a run to about 124.40, 124.50, failed there again, and is now finding a little bit of support near a 120. The data is painting a bit of a mixed picture. Obviously, the UK avoided recession, or the technical definition of recession rather than Ryan's definition, in the fourth quarter, but GDP did contract by 0.5% on a monthly basis in December. Despite that, the labour market remains very, very hot indeed. Unemployment close to record lows, and earnings excluding bonuses, so regular pay, rose at its fastest pace on record in the month of December, excluding the pandemic period. We obviously had the inflation data out on Wednesday morning, showing headline prices and core prices coming in substantially cooler than expectations. So the market is now thinking, pretty much cementing its view that the BOE are going to bring the hiking cycle to an end in March. What do we think is the outlook going forwards, not just for the economy, but also for UK assets? I'm thinking the pound, the FTSE, which is trading around about 8,000 at the moment, and also gilts. As we get towards the end of the tightening cycle, and as these economic indicators evolve, growth slows, the labour market remains tight as we move into the remainder of the year. David, I'm going to come to you first.
Well, the FTSE's not really representative of the UK, firstly, is it?
25% of revenue.
Sorry?
25% of revenue is all that's generated in the UK.
Exactly. And 70% of sales done by FTSE firms are done in dollars.
I thought you were going to say 75% is elsewhere.
That would be great maths. But yeah, you know, it's not representative of the UK. It's still a fantastic base to collect dividends in, though. But again, you know, it's symptomatic of. I had a go at Germany last week, so I've got to have a go at the UK. It's symptomatic.
Make yourself a cup of tea, everyone.
It's symptomatic of how stagnant the UK has become, because we've just got an index that is packed full of miners. We've got an index that is packed full of the most boring consumer staples and utilities firms. Like, there is nothing inspiring about the index. Like, obviously, I totally understand that, you know, the New York Stock Exchange, the NASDAQ, is packed full of high volatility meme stocks and rubbish, like it is. But it still shows that there is a base in the US of people trying to think about things and invent new things. And the problem is that we have a lot of smart people in this country, but they tend to go over to the US because that's where they can get paid more. You know, a developer here would probably be on maybe half the salary that a US firm or one of the big tech guys over in the US could
Yeah, but you're doing a bit of discredit then, because it is sort of like apples and oranges. It's like, you know, standard of living, you know, it depends on the metric and stuff. And, you know, then if you wanted to deep dive into it, then you've got the healthcare situation and stuff. So although I take half your point, I think, you know, saying, oh, you can get more money elsewhere, I don't think it's as straightforward as that. Sorry.
I'm speaking from a high tech perspective and directly relating it to the composition of the FTSE. There is nothing exciting about the FTSE, basically, is what I'm saying.
But then you've also said that you don't need to be a UK company or therefore UK employee to be in the FTSE 100. So
no one's going to get listed on the LSE when, you know, they're a massive tech company and all the.
Well, I've
somehow given. Sorry to interrupt there, Ryan. I've fat fingered that awfully.
Oh my day!
You're in massive agreement.
I thought he was going to have a point knocked off then.
I think he was on 7, but we'll put him back to 8.
6.
I tried to give him 1 point, and I gave him about 20. So apologies for that. That just to refute any accusations of bribery going on.
But my point is really to do with, you know, there seems to just be a lack of desire to progress things. Things just get sold off. You know, we saw with ARM, for example. We see with our nuclear stuff, Rolls-Royce sold off a portion of things to the Chinese. It just seems to be that we broker a lot. And there's nothing wrong with brokers, although many are crazy. But, you know, we seem to be a country purely of middleman business, which is fine.
Services, mate. It's called services.
Yeah, but there's services, and then there's I feel like there's a slight difference when it comes to the FTSE. But basically, I just feel like UK assets are fantastic for a longer term dividend play. To trade, absolutely diabolical. All you have to do is look at a chart of the FTSE. Unless you're trading like, you know.
What you mean, the FTSE that's at all time highs? That FTSE.
Yeah, but if you look at it over the last couple of years, it's not volatile enough.
What would you rather have, volatility, or would you rather have gains?
Well, if it's from a trading perspective, then you want volatility.
Ryan,
that's why I made the point earlier that I you know, throw money into VOO, which just tracks the S&P 500 each month. You know, there's a difference between trading and passively.
Yeah, true.
I think is the key difference. But yeah, I think the pound, obviously, with the divergence between the BOE and the Fed, you know, BOE wanting to stop the rate hiking cycle, which personally I think is a bit crazy, in March, and the Fed pretty much pressing forward. There's a clear divergence there, and I think you can take that trade of probably selling the pound, alongside obviously the risk dynamic as well, which sterling's quite closely correlated with.
Yeah, of course. Dick, I want to bring you in because I know you've been short sterling for a while. What are your thoughts on the pound at the moment? Obviously, we had, I think it was Ten Rayro from the MPC talking about the potential for, while Ryan does his Scooby-Doo impression, talking about the potential for rate cuts, voting for a rate cut when she was testifying last week. I'm keen to get your thoughts on that because I know you'll have an opinion on that.
Ten Rayro, what a great name! Is it like von der Leyen? You hear it and you think of ABBA almost. I know I can't be rude about the Bank of England, or too rude about the Bank of England. To me, where are the bigger clowns, the Bank of England or in the Houses of Parliament? I don't think the Bank of England's got a clue what's going on. Rates are much too low here. The economy's absolutely, excuse my language, screwed. It's just a nightmare. You walk around, I'm very lucky based in Mayfair, but even the Mayfair shops are closing. I just think that it's a real mess that they've created here. You're putting up corporation tax, and why the hell are they doing that? Going back to what David was saying about components of the FTSE, how are you going to attract people to invest into this country and open up businesses when you're going to get absolutely crucified on corporation tax? So I think you've got a bunch of clowns in the Bank of England who don't know what they're doing. Ruling by committee, which is a disaster and has been God knows how long with the Bank of England. And then in the Houses of Parliament, you've got a Conservative Party, which is an absolute basket case. I think that Sunak's on a very short leash. I wouldn't be at all surprised to see Johnson come back in June, which would be great fun for the markets. And you've got a Labour Party which just about keeps the lid on the left wing. So to me, I can't see any reason to buy sterling apart from to cover shorts.
So cable below 120 then?
Yeah, 118.5.
118.5. There we go. Ryan, how are you thinking on all of this? I know you've got plenty to say.
Right. So firstly, I completely agree with my right honourable friend, Dickie Matthews. The BOE, most unreliable central bank in terms of most things, including even more importantly, communication. I'm glad we brought up 10-ray rule. Has to be said in a Scooby-Doo voice. She literally said before a couple meetings ago, 2 weeks before the meeting, that she wanted to cut rates, and then she voted for a hike. So it doesn't get more ridiculous than that. Okay, so I'm the biggest bull for cable at the best of times, but I hate myself that I'm not saying to buy a bit of Betty Gable. What would I prefer to? Yeah, what would my preferred trade to be? Sorry, maybe, and obviously this is me being just against the runner play from what we've heard so far. But given the fact that FTSE 250, FTSE mid cap, whatever you want to kind of call it, is 20% off the highs. When you look at global equities as a whole, personally, I think that's a decent trade to get along that. Just because I see some upside in it. Really, I'm not massively bullish UK PLC, but I'm not exactly bearish UK PLC. So FTSE 250 mid caps would be my trade to be long. I hope I get a bonus point for honesty here, and I did look, but I couldn't find a Pepstone instrument for that. Maybe this is something that everyone can kind of complain to Pepstone about and say, look, let's get some UK PLC trades on. I agree with everything that Dickie said, and to an extent, I agree with what David said. I do think David was a little bit harsh on UK PLC.
I like to only be harsh because it makes the point a little bit better.
Carrot and stick.
And by being harsh, you can rack up 25 points, it seems, on this show.
Well, there we go. Exactly. That's
it. Well, I must say, I'm not particularly surprised by the views that you've offered there. And actually, I would probably agree with most of them. I don't think sterling has much going for it at all at the moment. But let's dig into the FX market in a bit more detail in the next round. So I'm going to come to David first, given that he's professed his accuracy when it comes to he's already in this show. He knew that was coming. He must have known that was coming. It seemed that the tide had started to turn a little bit in the dollar's favour after the payrolls number, after the ISM print, after another kind of dovish BOE decision at the start of the month, and just, frankly, a confusing ECB press conference, if anyone can think back to that at the start of February. But again, as with kind of the broader theme of markets at the moment, we've then entered into this kind of consolidation phase, and the market became just a total mess yesterday or Tuesday afternoon after the CPI print. But broadly, we're pretty range bound across the board when you look at G10. What would be your kind of trade idea of the moment in G10 FX at the moment? What's hot and what's not? What should we be looking at?
Well, I'm going to talk my own book and sell Aussie versus.
You're not going to talk someone else's.
I think for me, that trade probably makes the most sense, especially if you want to express maybe a slightly bearish tilt on risk as well. I think the RBA being quite soft is quite an interesting one, and the repricing in rates for me is quite important there. Trade the dollar side of things. It's a view that I quite take a technical perspective on as well. It just from looking at the Aussie, it's relatively weak. It's been in a downtrend since the start of 2021, February 2021, so 2-year downtrend, and it's kind of broadening a little bit, which I quite like. We had a steady up move in Q4-ish, Q3, Q4 of last year. And it's one of those that I'm in favor of I think China probably weighs a little bit there as well. If you want to take a view on, even though China's opened, demand's still probably stagnant. I think the property sector's weighing heavily there on the wealth effect in China. And yeah, that will likely weigh on the Australian economy a bit as well. But really, the predominant view is the differentials between interest rate policy.
Good stuff. Cheers, David. Ryan, let's go to you next. What are you looking at in the FX space?
So FX really isn't my bag. What is? I can hear you saying from here. But one thing I did want to kind of raise, as I've noticed a little bit of it this week, is yen. More particular, the next governor for the Bank of Japan. Prepare for me to butcher some language. A bit Kazu Ueda. I don't care how it's really pronounced. That's how I read it. That's how I'm saying it. There's been certain talking heads saying that this is like ultra bullish yen because it's not, it's going against, like what was seen as kind of the obvious choice. That's nonsense. And also the same people are also saying that we've gone an outsider of Japan's policy and political establishment. Again, is absolute bollocks. He was a Bank of Japan board member from 98 to 2005. He is the shogun of forward guidance. And I'm coining that phrase. I've not seen it anywhere else. The shogun of forward guidance. He was the guy, the geezer. I don't know what the translation for that in Japanese is, but the geezer who introduced forward guidance to the Bank of Japan when it first adopted zero interest rate policy, the old ZERP world order, which we spoke about before, in the late 90s. So to say he's not with it and he's completely against all like ultra policy.
Ryan, that opinion was coming from someone with wild opinions, though. Yeah,
but it's just bullshit. He's not gonna flip ultra loose policy on its head. He's going to be, as we all know, he's going to be data dependent. Everyone is data dependent. So to say this new guy's coming in, it's ultra bullish yen, is lazy and is inaccurate, and that's really been bugging me this week. Personally,
well, now you've got that on your chest.
Sorry, go on.
No, I was going to say, well, how would you play it? Would you be short?
So personally, I think the yen has further to fall. I think you take out, I know, obviously the dollar yen is the biggest component of the yen index. Pepperstone, the amazing broker that they are, they offer a yen index to trade. Looking for my bonus point. Is it coming? JPYX on Pepperstone. It's 7% off the October lows still. The only reason perhaps it's up here is because of this view of, it's all of a sudden the yen, the BOE is going to get ultra hawkish and stuff. It's rubbish. And there's no reason it can't retest the lows in the next month or so, or like 3 to 6 month period. Don't believe the hype. BOJ, Bank of Japan, there is no way they are turning on a dime and going ultra hawkish all of a sudden. It's just laughable.
Well, mate, they can't. They're so entrenched.
Well, exactly. It's but they are the market. They can't exactly.
Just going back to that view as well that Ryan's referring to. It's probably going off on a little bit of a tangent, but one thing that I've had an issue with recently is people on Twitter with many, many, many followers sort of playing into a certain crowd that thinks that they understand every single component of the world. And when they find something that sounds really super niche and super like, yeah, I'm smarter than everyone else, they really latch onto it. And it really, really gets on my goat. And people that, may not be as experienced would listen to this and think, yeah, they know what they're talking about because they sound different, when really they're just talking absolute. Yeah.
Yeah. No, I think you're absolutely right. And I think that's why it's important to admit when you don't know. If FX isn't your thing, if equities, you don't have a read on it, admit it. There's, you are never.
I made a career out of that.
When it comes to the market. Dick, what are you looking at in the FX space at the moment, besides your short sterling view?
My perennial short sterling view. I actually agree with Ryan. I think Ueda is going to be absolutely unchanged. Giza-san, I think he's going to be known as, although many years ago he's been a money broker called Ueda, so it can't be that an uncommon name. But Giza-san, I think, is going to leave policies as they were, so I'd be a seller of the yen. I still like the dollar, and I'd be a buyer of the dollar, seller of the yen. I don't know particularly about the Aussie. I have a sneaking suspicion that oil's going to make a comeback. I think that Putin's going to have one last squeeze. So on that basis, I keep an eye on the loonie as well. But really, my big play would be shorter sterling against whatever currency I could find to go short.
Against all the currencies.
Just euros. And I offer over. But I think the yen could be an interesting player because I think people actually, as Ryan says, and I'm happy to agree with the young man, are misreading the change in Japan. They just don't change. They take years and years and years to change policy, and I just don't think they're going to now. I think they're entrenched and will stay as they are. So really, sell sterling, sell yen. Might be a little bit younger. No, I can't say longer euros. God, no, I take that back. And of course, most interesting thing tonight is come on Arsenal. As I guess we're wrapping up. So looking for 3 points for Arsenal.
Indeed. Well, on that note, we will keep our fingers crossed for that, and we'll have a look at the final scores.
Oh.
So, unfortunately, it looks like I'm going to Mayfair to deliver 2 wooden spoons now.
Back to baking.
So, sorry about that, Dick. I will bring them over to you at some point. I've got to get them engraved first. David in second with 13, and somehow Ryan is leading with 15. Ryan, well done, mate. Leading the pack even when you're sick, and Nelly the elephant has made a return.
It's all down to Nelly. I'm not going to lie.
Can you give Ryan a certificate that he can replace that rather sort of odd show of tin cans behind him?
Give me something, please.
Exactly, I might have to. Well, in that case, that does wrap up the show for this week. Thanks to the guys for joining me. Ryan Paisey from PIQ Suite, David Belle, Macrodesiac, and Dick Matthews of Pardus FX. Do check out their social media and their websites, which will be linked in the description below. Thank you also to Kyriakos, our producer, who pulls all this together brilliantly every week. Hope you enjoy the show. Do drop us a comment if there's anything you want us in particular to discuss next week. We will be back then. In the meantime, enjoy the rest of the week. Have a good weekend, and we'll see you again soon. Thanks for watching, and goodbye for now.